You're listening to the Talking Air Filtration podcast, where you get to know the people that make air filtration possible and help us all breathe easier. Because clean air matters.
We'll get insights from air filtration professionals and learn how they became successful in their careers. Along the way, we will discuss best practices, guidelines, trends, and challenges in air filtration in a variety of applications. We hope HVAC, air filtration, and indoor air quality pros, including business development, engineering, building owners, and facilities management, will enjoy the insights our guests will bring to this podcast. In this episode, we welcome Alex Chausovsky for an insightful economic and labor market update. He'll break down key trends in inflation, interest rates, labor market conditions, consumer spending, and business investment, offering actionable advice to help businesses navigate economic transformations. Stay tuned for expert insights you won't want to miss.
Okay, so let me introduce our keynote speaker, Alex Chausovsky. Alex is today he's going to focus on the economy and labor market. After which he will lead us in a roundtable discussion amongst all of us here today. Tomorrow, the conference will be around building an effective talent strategy. Alex is a highly experienced market researcher and analyst with more than 20 years of expertise around the country and across subjects including economics, industrial manufacturing, automation, talent and workforce issues, and advanced technology trends. For the last 2 decades, he's consulted and advised companies through North and South America, Europe, and Asia. And his insights and analysis have been featured on NPR, the BBC, and the Wall Street Journal. Please welcome Alex to the stage for us.
Thank you so much, Randy. Appreciate it. Thank you, Randy, for that wonderful introduction. I appreciate that. Thanks to all of you for being here today to educate yourself, to stay up to date, to network with all of your industry peers. And as was already mentioned, it's a pretty big deal for you to make it all the way out here to Maui, so we appreciate you. I'll start my presentation by asking you a very important question. Who's ready for an hour of economic data and charts on this morning, right? Woo! Yeah, let's go. Well, you should be excited because not only am I going to tell you about what's going on in the world around you, and most importantly, as it pertains to the economic outlook, I'll provide you with actionable and practical advice throughout the presentation that will hopefully allow you to drive your business better and more efficiently and onward and upward into 2025 and beyond. So you can see I've titled the presentation From Analysis to Action, Driving Business Value Through Insights into Today's Economy. There's a lot going on, and it's oftentimes very difficult to parse what you should be paying attention to versus kind of the noise that exists out there. My goal with the presentation today is to help you zero in on the things that really matter and that will affect your business not only for the remainder of this year, but into 2025 and beyond. And I do that from the perspective of building my career for the last 30 years of providing advice to business owners and leaders that are responsible for all sorts of decisions: operational, capital investment, M&A oriented, strategic planning. And so all of the content that I'll present, it's going to be a little bit unusual relative to the typical economic presentation that you usually see, because all of the focus is on helping you see what you need to do better based on what the economic data is telling us. I also think it's important for you to know a little bit about me as a person. Beside the introduction you heard, I was born in Kyiv, Ukraine, and I emigrated to the United States when I was 10 years old. So I am the poster child for living the American dream. And the reason it's important for you to know this is because I am extremely bullish. I'm very optimistic that despite the very real challenges that we as a country face, that we will be able to overcome them as we have in the past, and that we should be looking forward to the future, whether it's the economy, geopolitics, any of the things, with optimism. And I want you to walk away from the presentation today feeling optimistic about your prospects for 2025 and beyond, and then knowing what to do to make that optimism come true. The obligatory slide about Bundy Group, which is the company that I present, we basically are a very small boutique M&A advisory firm, an investment bank out of Charlotte, North Carolina. We help typically in a situation of a sale or an M&A type of transaction, whether you're trying to raise capital to buy somebody, whether you want to sell your business, we're there to support you. If you have any questions, you can always reach out to us. So I'll leave it at that. Our talk today is going to focus around three kind of key areas. Number one, we're going to look at the state of the economy as it stands today and what the prospects are for the near term. We're going to get some input from something called leading economic indicators. Being able to predict the future when it comes to the economy is not impossible. There is a system that I will teach you that you can leverage within your own business that you should be able to see around the corner. The next 6 to 12 months should be pretty telling about what's likely to happen, and that will help you plan better in terms of inventory management, in terms of production capacity planning, in terms of hiring of staff, and all of the things that go into being prepared for the demand of the marketplace in the future. I'll wrap it up with a very quick take on the labor market. We have a whole different session we're going to do tomorrow together that focuses on strategy. For the last 2 years before joining Bundy Group, I built an analytics and consulting practice for a recruiting firm. And so I saw what worked effectively day in and day out in terms of attracting talent to your organization, effectively putting them through the onboarding and hiring process, and then retaining the folks. So I'll share some of the insights tomorrow, and then actionable takeaways throughout the presentations. So let's start with the big picture view. I always think it's important to start here because there's a lot of misinformation that gets spread, whether it's online, in the press, in the media, on television, or in print, about where the US stands today relative to the rest of the world and what our prospects are. So this data comes from a really great source. It's called Visual Capitalist. Highly recommend that you check it out if you get a chance. Most of the information there is free. But on the left-hand side, it's basically the global economy presented in a unique and interesting way. And on the right-hand side, you can see what has been happening with the major economies of the world. So let's start on the left. First, I want you to understand that despite the rhetoric, the United States remains firmly atop the economic pyramid. We are the global macroeconomic superpower. We are the leader. You can see China below us is about 30% smaller than the US economy as it stands today. And with the growth rates in the Chinese economy slowing significantly, there is no chance that the economy in China is going to overtake the US for that pole position in the foreseeable future. I personally think that because of the demographic challenges the Chinese economy faces, because of things like the one-child policy and the way that the government manages investment in that country, they will never overtake the United States. So we remain very key to the global economy in that leadership position. The other thing that I want you to see on here is if you look at some of the other major economies in the world, Germany, England, France, for example, you take Europe as a whole, you add that to the US and China, and you're basically talking about 2/3 of the total global economy represented by those three entities. It's important to know that because a lot of times our newsfeed is inundated with coverage of other countries that are not actually that significant on the economic landscape. So a few that come to mind, obviously Russia at the top of that list, Iran, North Korea, and some of these other states that like to rattle their sabers quite a bit. So they're loud, they're ornery, but they don't actually matter all that much from an economic perspective. You'll see Russia here. I'll point it out on the $2 trillion economy. What most people don't realize is that the economy of New York City is larger than the entire Russian economy. It's really quite remarkable to think about how much press coverage they get relative to their importance from an economic perspective. So I actually, and of course, me being from Ukraine comes into this, but I like to think of Russia as basically a gas station that happens to sell guns. Like that's basically the notion that I go to. And to validate this perspective, I actually asked AI, I just typed in Russia, and I asked it to generate an image for me of what Russia represents, and this is what it came out. So you can see it's basically what I was talking about. Let me go back for just a second here. I think in more serious perspective, if you look on the far right-hand side, again, this notion that we are somehow giving up, that we are losing the economic game, that we are giving share away to other countries, whether it's the overall economic footprint, whether it's the status of the US dollar, as the reserve currency of the world, whether it's our importance in terms of when it comes to global trade, a lot of that is totally overblown. So if you look on the right-hand side, the top line, the white line, notice that since the pandemic, the US has actually gained in share as a percentage of the world economy. You can see the blue line, which is the EU. You can see China. Since COVID, again, because of the lack of rebound once they reopened their economy, those shares have been going down. Now, I like India at the bottom of the list, but Japan, the UK, many of the other established Western economies have been giving up share. Not so for the United States. You can see basically where we stand today at about 26% is where we were roughly at the beginning of that calendar, 1980. So we're talking about a 50-year span where we have held on to the percentage of the global economic footprint that we had almost 50 years ago. So again, the reason I'm telling you this is because I want you to challenge yourself to not buy into the hype, not buy into the negativity that exists out there. The United States is blessed with so many unique circumstances that allow us and will continue to allow us to be the #1 global economy. I'll give you a few examples. So think about the location of the United States on the globe. We are buffered on either side with 2 oceans, Atlantic and Pacific, and we have friendly, non-threatening neighbors to the north and south, in Canada and Mexico. That means we are under no imminent threat of invasion in this tumultuous geopolitical environment. So unless we decide to get ourselves into a war is not likely coming to our shores. That's a very privileged position to be in. We have the deepest and widest financial markets, so access to capital, the ability to take on risk, the inventiveness, the creation of new products and service of new ideas. We reward risk-taking in this country. Most of the other global economies do not, including some of the better established ones like Japan and Germany. They're very conservative in their nature. We have 8 of the top 10 universities in the world. And so when the rest of the globe wants to send its best and brightest to school to educate themselves, to become the best version of themselves, they think of America first. The only 2 universities in the top 10 that are not in the States are Oxford and Cambridge in the UK. And the list goes on and on and on. We have natural resources. We have the rule of law, which are not present in many other places. And so I hope you're starting to see this picture emerge that the United States is very well positioned at that top, and it's not going anywhere. So with that in mind, I think it's important to shift the narrative to what drives economic performance. And at the end of the day, what you'll see is it is people. It is you and I as individual consumers that will drive the performance of the economy. And with that in mind, you have to start paying attention to where the people are today and where they're going to be in the future. Because where people move to, that's where demand is going to come from. That's where new construction is going to happen. That's where new opportunities to sell filter and associated products are going to come from. So this is the latest available data that we have. It's through middle of last year. And you'll notice the states in that bluish tint, so places like Florida, Texas, the Carolinas, Utah, they are the beneficiaries of people moving into those areas. The states that are more red or orange in color are the losers in this case, where they are actually seeing people leave those locations. And we're talking about places like Illinois, California, New England area, particularly New York and Pennsylvania and so on. So the reason why I think it's really important for you to know this is because it's not just about where your business is going. You've got to think about where are my customers that I'm selling to positioned. Are they exposed to the markets that are growing from a population perspective, or are they in the markets that are actually shrinking? And you've got to think about strategically, how do I give myself the best chance for future growth by following where the people are going? That's a very important notion for you to have here. And that notion is actually supported by GDP growth. So GDP is gross domestic product. That's the catch-all name for economic activity. And you'll see here, these are the states that had the top performance in 2023. A lot of overlap with the previous map. Texas is on there, Florida. There's some nuance here. For example, last year we actually did a lot of natural resource mining in the United States. So places like West Virginia, mining for coal, places like North Dakota, oil and gas, obviously Texas and Oklahoma for oil, Alaska for some of the natural resources available there. But the economic growth follows where the people are. And so that's the notion that I want you to think about when you're planning for long-term expansion of your businesses. How do I take advantage of that growth? Another element that I think is going to be increasingly important for you as you plan for 2025 and beyond is the geopolitical landscape. So most people don't realize this, but 2024, obviously we have the presidential election coming up on November 5th. We've got a lot of other local and state level elections going on, but half of the world population is growing through a major political process this year. And the reason why that's so key is because policies, whether it's regulations or environmental policy or other things that drive your business from a technological perspective, from a product quality perspective, they're going to be shifting and evolving. And so you really have to spend some time and prioritize paying attention to what's going on in these various places, especially if you're sourcing from those places or are selling to those places, because that policy landscape is going to change, and that will require you to adjust to those changes that are going on. You can see on the map, all of the areas in the red are going through some sort of high-level, either presidential or prime minister, or some sort of key election process this year. Within the United States, looking beyond the presidential election, you've got 34 of the 100 seats in the US House up for either re-election or a new person coming up. All 435 seats in the House of Representatives and 11 of the 50 governors are also going to be elected. So that shows you how quickly the change can happen here at the local level, at the state level, or the municipal level as well. And this really is a call to action for you to broaden your perspective. Don't just pay attention to what happens in the White House on November 5th. You've got to think about the state level and the city level as well, the county level. Those changes might affect your business. Generally speaking, I get asked this question more often than any other. What is the effect of the economy, or of the presidential election on the economy? And the answer to that question, ladies and gentlemen, is it's minimal. And this is the truth of it. And I've looked at this for many, many years, because the US economy, as broad and diverse as it is, think about it as an aircraft carrier. It takes time to change course for a ship that large. It requires a lot of different policy developments. It is not simply, oh, we have a new person in the White House, therefore everything is different all of a sudden. Typical policy, especially the big pieces of legislation that move the needle from an economic perspective, takes somewhere between 12 and 18 months to pass, and another 6 to 12 months before they actually start to affect things on the ground. So if you look at the past two administrations, the case is made very clear. President Biden's agenda, it took 2 years to pass the Infrastructure Act, the Jobs Recovery Act, all of these things that are actually starting to have a positive effect on the economy now. In President Trump's term, it took 2 years to pass the tariff regime that then affected the economy 12 months later. So it is not immediate. And I guess what I'm really trying to say here is don't let the political craziness of the next couple of months affect your decision making. Focus on the things that you can control. Run an efficient, profitable operation. Look for opportunities to save money because the cost of doing business is likely to continue going up. Be judicious in calculating your ROI on investments, whether it's a new piece of equipment or a new plant or facility. These are the things that are actually within your control. That's where the large majority of your mind space should be focused on, not on the outcome on Capitol Hill in November. What we see during the election process is a spike in something called political uncertainty. So here you can see, going all the way back to January of 2015, there are multiple periods throughout this time frame where there are spikes visible in uncertainty. Now, the biggest one, of course, you can see there is the COVID-19 pandemic. Obviously, that was an unprecedented global event. Nobody knew what was going to happen. And so there was the most uncertainty we've ever had. Previously. But the other two spikes that you can see there are around elections. And the outcome of these spikes in uncertainty is that business leaders tend to pump the brakes. They're saying, wait, I'm going to hold off. I'm not going to make any kind of major decisions, and I'm going to wait and see what happens. I'm going to see who ends up winning the election. I'm going to see what policy changes are likely coming to bear as a result of that. And so what we see is that there is a very minimal shaving off of about 0.2% of GDP as a result of that, and that is concentrated in, roughly speaking, the 4 to 5 quarters after the election. So there's going to be a very, very minimal impact. Otherwise, you really shouldn't concern yourself with the potential negative impact of who gets elected into the White House. Be broader in your consideration, pay attention to the policy rather than the people, and then make the best decisions you can with the information that is available. The last point I want to make on the political side, and of course there was no getting around this, is how polarized we have become as a nation. And so a lot of the things that we read and hear, we tend to operate in mini bubbles. So this chart is a really good example of that. This is the result of a survey from CBS News. Now, CBS is fairly down the middle of the runway. They're not too far left. They're not too far right. And this survey basically asks tens of thousands of people around the United States, do you think the economy is doing well or not? And then it tracks the response by their political affiliation, red being Republicans, blue being Democrats. So what I want you to take away from this chart is we really have not been aligned as a country about our outlook on the economy since the Clinton administration of the late 1990s. Starting with George Bush Jr., you can see the Republicans during 2000 to 2008 thought the economy was doing very well, whereas the Democrats thought it was doing very poorly. Then it flipped during the Obama years. So then the Democrats started to think, oh, no, it's growing great. The Republicans said, nope, it's terrible. During Trump, the flip happened again, and the same thing can be observed right now with the Biden administration. So most people don't realize this, but when you see it put into such context, it's very difficult to argue with that. In particular, what I find fascinating about this is if you look down here, so the current Republican perspective on the state of the economy is basically at the same level as it was during the Great Recession of 2008, 2009. Now, we know intrinsically that the economy is not doing as poorly as it was in 08, 09, and yet our opinion of that, our outlook about our perspectives and what's going on right now is really quite driven by the political kind of bifurcation or the rhetoric that exists out there. So the reminder that I wanted to leave you with on this subject is when you're making decisions, try to be less opinion-driven and more data-driven. As a business leader, it is key for you to be driven by data, and not all data is created equal, so you need to make sure that that data is reliable, it's vetted, and is actually reflective of the world around you. Okay. This next chart is probably my absolute favorite in the whole presentation. This image was produced at the beginning of 2024, and they asked all sorts of different sources, what do you think is the likelihood that there is going to be a recession in the United States in 2024? Now, observe the spread first and foremost. On the far left-hand side, we've got the Federal Reserve staff. Now, the Federal Reserve, obviously the body that sets interest rate policy, they have a team of hundreds of economists on staff. At the beginning of 2024, they predicted that there was a 0% probability of recession happening this year. The yield curve, and I'm sure you've heard about this, the dreaded inversion of the yield curve that has historically been pretty accurate predicting recessions, it said 60% chance of recession, but it has been saying that for over 2 years now with no recession in sight. Economists, just general private sector economists, you know, the guys that say on the one hand, but on the other hand, well, not surprising, about 50% of them said there is a recession coming. The other 50% said no. You and I, as individual consumers, are actually quite pessimistic. At the beginning of this year, just like at the beginning of 2023, we had a negative outlook. Nearly 70% of us thought that there was a recession coming in 2024. But the banks, these are the institutions that track our actual behavior, not our opinions, but how we spend money. They were much more optimistic. You can see Goldman Sachs, Bank of America, much lower probability of recession because they see us out there eating at restaurants, taking vacations, buying things left and right. So our behavior has not matched our outlook, or at least our stated opinion. And the far right-hand side is the most interesting to me. The CEO, the person that is responsible for the key decision-making of every organization, 85% of CEOs thought that there was going to be a recession in the United States in 2024. Now, of course, we are here in October. There is no recession in the United States. And it really shows you how, depending on your perspective, and with the CEO, it's a perfect example. A CEO is someone who is compensated based on outperforming expectations. So, of course, you're going to set the bar low so that you can then be granted stock options and bonuses and all this kind of stuff. But generally speaking, it is really key to see how different the perspectives are. Now, I can say without a shadow of a doubt, there is no recession in the United States in 2024. And so in hindsight, it was the Federal Reserve staff that nailed it right on the head. This is supported by data. So let's get into some of the actual irrefutable facts of the economy. This is real, so it is already adjusted for the impact of inflation. We've taken the impact of pricing out of this data. Gross domestic product, GDP. Again, this is all of the economic activity in the United States. And what I want you to see is through the second quarter of this year, we haven't gotten 3Q data yet. It's coming in the next few weeks. But through the second quarter, not only were we continuing to grow, we were at a record high, which means that the US economy has never been more robust, more vibrant, or bigger than it is today. No recession in sight there. But when you look at the economic data, I think it's important to look below the surface. So imagine a person, right? You can tell a lot about a person by their physical appearance. Their skin tone, are they sweaty? Is their hair disheveled? But in order to really be able to tell if that person is healthy or not, you've got to look below the surface. Cholesterol level, heart rate, blood pressure, all of these medical things that you can't see by looking at the external appearance. So the same way you can look at the economy. This is the face value of the economic picture. This is the business cycle. Okay? These are the growth rates associated with the chart that I showed you on the screen before. This is year-over-year growth tracked over time. So you can clearly see that there are periods of recession here. This is 2008, 2009, when the values fell below zero. This is the much shorter but much more painful 2020 recession, where we shut down the economy for 3 months, basically, and so no economic activity could be happening, or at least a very limited version of that. And where we are today, now that we have bounced back from the pandemic and have the growth rates have normalized, you can see we're actually performing better than the average 2% growth rate looking over this entire history. So not only is the economy at a record volume, we are also growing faster than we typically grow. This is through the second quarter of this year. So again, when people say there's a recession in the United States, I say, show me that in the data. I'm not seeing it, at least when I look at GDP. So it's important for you to understand where you're looking. When you separate that GDP into its various components, it's really important to understand what drives the economic performance. So here, I've put it in the simplest terms that I can. Personal consumption, when you and I go with our family to a restaurant, where we're buying clothes, electronics, cars, furniture, houses, when business, all of this kind of stuff, anything that you and I as individual consumers spend is captured in that. That is 2/3 of overall GDP. The other two components are also important, government spending and business investment, but clearly you can see the main economic engine of the US economy is individual consumers, like you and I. And segmenting that, you have to say, okay, business investment is key. That fluctuates more than personal consumption. The government spending element doesn't really change much. It's all appropriations and budgets. It's set in advance, and then it doesn't really go into recession. As I'm sure you can attest, government spending continues to grow over time. So it's really the red and the blue sections that we have to kind of drill in on to understand what is the prospect for our economy as we look to the future. So let's start with the blue section because it is so much larger. The best way for me to show you the state of the US consumer is by using a series called Retail Trade. Okay? This is the dollars spent in the retail environment, and it covers both food and non-food items, both durable goods, which last more than 2 years, and non-durable goods, which tend to be replenished much more frequently. So this is the total. You can see very clearly the growth and the record territory where we are, but you have to understand there's been kind of a shift that's happened here. So this is the clear trend line that we saw before the pandemic. On average, retail activity grew somewhere between 2 and 3% per year between 2010 and 2020. Then, when we shut down the economy, we created this chasm during the period of COVID that really affected the things on the ground. And so there was this gap that I'm highlighting for you there in the circle. Since that we reopened the economy, there's been this surge of activity. I call it the revenge shopping spree, right? We were so fed up with sitting in our homes, plus we got all of this extra money from the government, so we went out and bought like there's no tomorrow. We bought everything, and that created the supply demand kind of misconnect that caused not only the inflationary pressure, which we've seen over the last 3 years, but also wait times of 2 years to get a refrigerator and things like that. So since about early 2023, we have basically entered this new normal. You can see the slope of that is basically what it was before the pandemic, but just at a much higher level. And what that talks about is the fact that we are paying basically 20 to 30% more for everything that we buy today relative to what we were paying before the pandemic. That is the reality of the world that we live in. And so I get people talking to me about this all the time. Well, it's the Biden administration's fault that this is happening. I'm saying, no, this actually began during and pre-COVID. And there are many things that go into effect here. But certainly tariffs that the Biden administration increased didn't help that. So they contributed to it. But the reality is we're never going to be paying lower prices than we are today. Prices tend to not go down. Over the last year to year and a half, we've been in what is called a disinflationary environment, meaning that the growth of inflation has been slowing, but prices continue to rise. What we don't want to see is deflation. That is when prices actually decline. Now, as a human being, from an emotional perspective, yes, I would love to see that. But as an economic analyst, that is bad news for the economy. Typically, deflation only happens during periods of severe recession. If the economy is healthy and growing, you will have some mild inflation, kind of what we have going on right now in that 2 to 3% range. More on that later. But the point that I want to make is, again, looking below the surface at the retail activity, you can see here that it is actually quite healthy. The two lines on here show you year-over-year growth in the dark blue line and the quarter-over-quarter growth in the light blue line. Right now, both of them are between 2 and 3%, which shows that we are not standing at the edge of an abyss. The U.S. consumer continues to remain vibrant and healthy, despite the fact that the job market is not as tight as it was before. We are both willing and able to spend money. The latest retail sales report actually exceeded people's expectation. So we are not staring at an imminent consumer-driven recession in the United States. That economic activity should continue to flow through the rest of this year and into 2025. You can see the two recessions in the retail environment. You can see that period of unsustainable growth that we went through. I mean, look at the dark blue line here. Peak retail sales in 2021 were at 20% year-over-year growth. Our economy is simply not set up to sustain 20% year-over-year growth. That's why we had all those long backlogs and lead times and couldn't get components and supplies. We just can't keep up with growth that's that quick. So the fact that it has actually decelerated and come down to that 2 to 3% range now is actually a good thing. It is more sustainable as we look towards the future. So I think that's a key element for you to take away from this conversation.
Are your air filtration personnel NAFA certified? Ask if they belong to NAFA and have their certified air filter specialist or NAFA certified technician designations. The CAFS and NCT designations are earned after rigorous exams and demonstrate that the air filtration professional has a high degree of knowledge and professionalism. To learn more about NAPA certifications, visit napahq.org.
As we say, what happens in the future? Can the US consumer continue to spend money the way that we have? We have to look at a very important aspect of our financial health, which is our debt. And so one of the things that gets talked about quite regularly is the fact that consumer debt continues to hit record highs. And I don't disagree with that. That's true. But of course it does. We have a growing population. We are a credit-driven society. And so, yes, consumer debt will continue to ratchet up new highs year after year after year. The question is not, is the debt level rising overall? The question is, how are we coping with the rise of that debt? And so when I look at this data, which, by the way, this is all freely accessible, the Federal Reserve Board of New York puts out a quarterly report on the state of the consumer health. You look at the different colors and you ask yourself, how are these areas doing? So on the bottom, you have mortgages. And the thin purple line on top of that is home equity lines of credit and other revolving debt around our property market. So basically, 72% of all of our debt is in housing. And the reason I'm not worried about any of that is, despite the recent rise in interest rates, 75% of all mortgages are currently below 5%. We are locked in. 55 are locked in below 4%, and about a quarter are locked in below 3%. So the US consumer, despite the fact that, yes, we are ever increasing in debt, most of that, 3/4 of the overall debt load, is in mortgages, which are very, very manageable because of the low interest rates that we have them locked in for. Now, it's the other categories that we have to really look at closely. So green is auto loans, blue is credit cards, and red is student loans. So we're going to look at that a little bit more closely. But before I do that, I want you to see that, when I say, are we able to cope with that debt, the best way to measure that coping mechanism is delinquencies. So that means what percentage of all of the loans that we take out are actually going unpaid. And I want you to see where we are today. So right here at 3% delinquency rate, overall on that $17.6 trillion of consumer debt, we are way below where we were pre-pandemic. The period of 2016 through 2020, we were roughly speaking 4.5%, 5%. We're currently at 3%. So yes, we've seen some rise back to norms, but we're nowhere near danger territory. As a result, I remain bullish that the US consumer is still going to be able to spend money in the future. But the devil is in the details. So let's look at the individual categories and their respective delinquency rates. The purple and yellow at the bottom here, those are home equity and mortgages. You can see there's some rise, but nothing severe. Nothing, again, we're just, in mortgages, we're back on par with 2015 to 2020 period of time. Student loans, there was a big discussion in economic circles in October of last year when the government lifted the moratorium on student debt payments. And everybody said, this is going to be that feather that breaks the camel's back. The US is going to go into recession because people will all of a sudden have to shift all of their spending to paying down their student loans, which they didn't have to pay during the immediate period after COVID. The reality is the government introduced a very gradual ramp-up system. And as you can see, the delinquency rates on student loans are way, way low right now, much lower than they were pre-pandemic. So it has not created that schism, that flaw that people were afraid of. So home equity, mortgages, student loans seem to be doing pretty well. The other two categories, I have to be honest with you, I'm growing increasingly concerned about. So we've got credit cards, this is the dark blue line, and auto loans, which is the green line. And you can see, just over the last 12 to 18 months, we have a pretty significant increase in both credit card and auto loan delinquency rates. Now, I always like to compare to historic norms. So when you look at auto loans, yes, they're above, but not substantially, and they look to be flattening out a little bit here. It is the credit card component that has me worried the most. We are increasingly, as a nation, turning to credit cards to fund all of the consumption, and the delinquency rates are significant now at 9%. So you look at back before 2008, 2009, where we were, at the peak here, we were at 12, 13, 14%. So we're not anywhere near those levels yet, but it warrants watching, because if this line, the blue line and the green line, continue to rise, it does not mean good things for the state of the consumer as far as future buying behavior, because they're defaulting on some of this debt at increasing rates. So I guess what I'm trying to say is, when I look at the holistic picture of the state of the consumer, we're fine, but there are clearly some cracks starting to form in the armor. I am very encouraged by the fact that the Federal Reserve has started to lower those rates, because the interest rates being very high is an extra burden on the US consumer. So now that those interest rates are declining, I'm hoping to see these numbers level off and turn back down. But we won't know for sure until the next few quarters. And so this is something that I'm watching very carefully. But given everything that I've talked about so far, I remain confident that the consumer is not at a risk of causing a recession in the next 6 to 12 months. So that's the good news. Now, shifting over to the other part that I talked about, business investment. This is a part of the economy that's more open to B2B. So that's basically the side of the economy that your organizations all operate in when you're selling not to individual consumers, but to other businesses. And this part of the economy has not been doing well for almost 2 years now. It has really been, if you look at the performance at the flat line, the US Industrial Production Index is the best way to measure the business-to-business economy. And you can see it's basically been flat to slightly down over the last 2 years. So a very different performance relative to what we saw on the personal consumption side. And when you look at the vital signs of the industrial economy, the growth rates, you can see on the far right-hand side, they're now in mildly negative territory. So minus 0.2% year over year, which means by technical standards that the industrial economy is in a very, very mild, but a recession nonetheless. And that has been obviously a factor of the extremely high cost of capital. Because when you talk about things that are more capital intensive, like equipment and machinery, things of that nature that are done as one-time purchases, they've been absolutely decimated by the high borrowing cost environment. Most small and medium-sized businesses, to borrow money, it's now 12, 14%. That's really restrictive from an ROI calculation, meaning people are saying, no, I'm going to make do with what I have until interest rates come down. So again, we see the negativity in the industrial space now, but the fact that we have started down the path of lowering interest rates is a positive omen that things will start to be easier in terms of borrowing and capital investment as we look out towards 2025 and 2026. So that mild contraction trend is very visible. This is a really interesting chart. So I hadn't been in investment banking for a long time, but I thought that there's a relationship between the value of companies and what happens in the business cycle. And so I compared the price earnings multiples that we've seen in the M&A space relative to what the business cycle of the industrial economy does. And you can see it follows quite well. So again, the main reason I wanted you to be aware of this is whether you're looking to sell your business down the road or not, you should be running your business as if you want to sell it, because that's what creates value in your own organizations. There are 4 key pillars to running a business that is deemed valuable by the marketplace. Number 1, stability of revenue. They don't want large oscillations in terms of growth and contractions like what you see in the oil and gas space or in automotive. Number 2, you want to have a sizable enough footprint, so you're looking for some scale. Typically, don't even think about an exit until you're probably in the 1 to 3 million of EBITDA range. Number 4 is consistent growth. So, it doesn't have to be astronomical, but something that you can prove over several years. And then the last thing that I want you to think about is diversification. You don't want to have all of your eggs in one basket. That means from a customer base, you don't want to be overly exposed to one particular vertical. From a supplier base, you don't want to rely on a key supplier as the thing that keeps you in business. Diversify on downstream and upstream, and then your management team. Your organization, if you're a leader, must be able to outlive you. So a diversification, well-run company with a lot of different perspectives is also key. If you can do all of that, the market will reward you with premium valuations when the time comes to sell the business, or to pass it down to next of kin, or create an ESOP, or whatever it is that you may want to accomplish as part of that exit strategy. Generally speaking, your industry continues to be viewed very favorably by potential acquirers. There are two different kinds of acquisitions that happen. Strategic, which is when a very large company, I'm thinking like a Parker Hannifin, buys a small or medium-sized business. And there's private equity, right? So both sides are seeing the type of businesses that you run as very attractive. So if you continue to gravitate and focus on those 4 key areas that I mentioned, you will be creating value in all of your business. Again, relative to say, whether or not you sell it at some point, it doesn't really matter. This is how you should be thinking about running the company. That's what is viewed as valuable by the marketplace. CapEx, as I'm sure you'll be not surprised, also has stalled in line with the industrial business-to-business activity. This is non-defense capital goods excluding aircraft. This is the broadest measure of CapEx, of actual investment into equipment and machinery that we track. And there, similar tendency. The growth rates are basically in negative territory right now, and so mild recession should improve as the interest rate environment eases. But for now, we do see that there's that downside pressure. So the summary is the consumer side is doing better than the industrial side, but as interest rates go down, the industrial side should start to see some of that rise that the consumer side has already been benefiting from. I did want to make one last comment from a vertical perspective. I know much of your business, just logically speaking, is driven by buildings and construction activity. And I just want you to see how different the situation is when it comes to residential versus non-residential. Understand that residential construction typically leads the economy by 12 months. So it is predicting what is going to happen. Non-residential construction lags the economy by 12 months. And the logic there is very simple. Companies must first make a lot of profit, then they can invest that profit into new buildings and new construction activity. So right now, non-residential has been benefiting from things like the Infrastructure Spending Act, the CHIPS Act, all of that kind of stuff, but it is starting to turn over. So we're actually expecting slower and then mild contractionary environment in non-res as we look out towards 2025. The residential space, particularly multifamily, is really seeing that surge. So you can see the arrows on the far right-hand side there. So from an opportunity perspective, you should be asking, are we facing the right side of the market when we're pursuing our customers? And if not, how can I pivot my business to take advantage of the tailwind that exists for residential right now, especially with rates scheduled to go down, and away from the exposure to the non-res sector, which, by the way, it's across all categories: commercial, healthcare, educational, religious, all of them have turned and are now decelerating. So mitigate the risk of exposure to those, offset that with some opportunistic perspectives into the residential side of the market if you can. So I've made the kind of allusion, I've mentioned leading indicators a couple of times now. I want you to walk away from this session understanding that you can see into the future of your company's business. It is not this crystal ball thing. There is a reliable, data-driven method for making that happen, and it's based on tracking the vital signs rather than the top-level view. So in this example, you've got 2 different series. The dark blue is a set of industry data. Imagine that is the filtration market overall, year-over-year growth rate, so the way that it's growing over time. The light blue is an example leading indicator. First, let's look at that peak. That happens in the 4th quarter of 2009, and then you can see that the corresponding peak in the data happens a year later in the 4th quarter of 2010. And what that suggests is that there's a 12-month lead time or predictive ability between the dark blue and the light blue lines. And you can see that consistently through the low and the high points. So this low here predicted that low. This low predicted that low, and so on and so forth. Each time the blue line turns about a year in advance relative to the dark blue line. So once we establish that relationship, that 12-month lead lag, what I can then do is take the last 12 months of data in the leading indicator and physically manipulate it by pushing it forward 12 months, aligning the low and high points, and then leverage the insights of the last 12 months of data in the indicator to predict what the underlying set of industry data will do. This works at the macroeconomic level, it works at the vertical market level, and yes, ladies and gentlemen, it works at the individual company level. So each one of your organizations has a set of leading indicators that you can look at that will give you, with a high degree of confidence and a lot of accuracy, at least the directional momentum that your business is going to have over the next 6, 12, in some cases upwards of 18 months. So if this is something that is interesting to you, I'm always happy to have a conversation one-on-one. But imagine the implications when you come to think about it. So let me back up one slide here. Imagine that you are the dark blue line and you're here. You've just gone through a period of accelerating growth in your business for 3 to 4 years. You're sitting at, call it 6% year-over-year expansion. You're feeling pretty good about yourself, right? So what are you going to do as the decision maker? You're going to be aggressive. You're going to invest. You're going to buy new equipment. You're going to expand your capacity. You're going to hire more people. But if you know that there's a period of 12 months of deceleration coming, and by the way, 12 months from now, I'll be flat, if that, maybe even mildly negative, the thinking changes. It flips, right? At the peak of the cycle is when you want to tighten your belt. You don't want to commit to long-term expenses. You don't want to hire a bunch of people. You don't want to spend millions of dollars on new equipment. You want to become more conservative in your decision-making. Same thing goes for the low point in the cycle. When you start to see those rates of change turn, that's the time to be aggressive. And I'll be frank, most people that don't see this, they will look at you like you're a little bit crazy. They're like, we're down year over year. What are you doing investing money? No, I can see, and the leading indicators are saying 12 months from now, we're going to be in positive territory again. So you want to be a half business cycle ahead. That's the key. You want to buy low, sell high. It's the same notion that applies to the stock market, but when you look at your own business on a business cycle basis, which is what these lines are doing, you can get that type of insight. So now that you understand the basic premise of what I'm talking about, let me show you why I'm optimistic that the US industrial economy is going to see some acceleration as we go into 2025. The first leading indicator, and by the way, this is already offset by the lead-lag relationship, is total industry capacity utilization rate. Simply put, this is what percentage of the existing production capacity is the industrial economy using right now to meet the current level of demand. And it has a 6-month lead time, as you can see, and notice the rise here off of the low point. So this says into mid-2025, we should start to see rise in that dark blue line, which is the industrial production index. So again, the rise here in the light blue line says rise in the dark blue line is coming over the next 6 months. The next leading indicator I wanted to share with you is copper prices. Why copper? Because copper has a PhD in economics. They call it Dr. Copper for a reason. It is so diversely used in so many different industries, automotive, electronics, construction, the list goes on and on and on, that it actually is a good foreteller of what's happening in the industrial economy to the tune of a 9 months lead time. Now, because it is commodity, it's quite volatile, so it's not just a straight line. It goes up and down, but you can very clearly see the momentum is to the upside. It corroborates or confirms the fact that there should be some rise happening in the industrial economy over the next 9 months. The next one is my favorite. It is the PMI, the Purchasing Managers Index. The reason why I like this series so much is it's got a very high correlation to the industrial economy, and it has a 12-month lead time. So it basically predicts things a year into the future. Now, notice, consistently you see this rising trend, but this downturn, which is now predicted for the third quarter of 2025, suggests that perhaps the Fed did wait too long to start lowering rates. That momentum eventually ebbed and is now slowly declining. So over the next 6 to 9 months, it confirms that we should see that rise. Beyond that is how quickly can we get those rates to be not restrictive where they have been for the last 2 years, but rather neutral or even accommodative, right? That's the key question that's being asked right now. But at least for the foreseeable future, what it says definitively is there's not further downside pressure in the industrial sector. We're not going to see a more significant downturn for the industrial economy than what we've already experienced for the last 12 to 18 months. So the holistic message here is be optimistic about the near to medium term future for the industrial B2B economy. And with that in mind, you should start moving accordingly. The decisions that you're making are, yes, we're low point right now, but how do we position ourselves to take advantage of the rise that is going to come in the near-term future? A few other elements that I wanted to mention just before we wrap things up, and I do want to leave room for Q&A on the back end because I know I've covered a lot of ground here. Generally speaking, we've won the war against inflation. Fairly consistently across the board, economists agree on this. But my perspective is we should be prepared for an environment that is higher inflation moving forward than what we saw before the pandemic. So I imagine that we're likely going to be somewhere between 2 and 4% on that inflation gauge. You can see right now, core inflation, which is the dark blue line, is still above 3%. That's extracting volatile food and energy prices. So the key takeaway for you here is the cost of doing your business is going to continue to rise. And I want to remind you of one very, very important fact. If you take away nothing else from my presentation today, let it be this. You are not in business to grow your revenue. You are in business to make a profit. And I think that many companies through the post-pandemic recovery period lost sight of that. They were so enamored with double-digit revenue growth that they were not looking at profitability the way that they should be. The cost of doing business continued to rise. As we enter this period of the next 12 months, your clients will likely be pushing back on any further price increases. So you're dealing with a double-sided squeeze in your business. Your costs will continue rising. You're not going to be able to raise your prices the way that you were in previous years. So be mindful. Look at your profitability, not only at the overall level, but at the product line level. Look at it by customer and identify the areas where you're not meeting those profitability targets and then make the necessary adjustments. Sometimes, and I know this is going to be very difficult for you to hear, that means you walk away from that customer. If they are not making a profit for you, you have no business in interacting with them. That's very hard, especially if you're a sales guy. It's very hard to do. But you are in business to make a profit, and that's what it takes to accomplish that. One last comment here. This is from the Fed. They're meeting in September where they decided to lower rates by 0.5%, and they gave future guidance about where long-term interest rate policy is going to be. Each dot here represents a voting member of the FOMC, the Federal Open Market Committee, and where they believe interest rates will finish each of these years. So 2024, 25, 26, 27, and then the longer term run. The key information here is look at the widespread. They don't really know, but clearly there's at least half of them that think that interest rates long-term will be somewhere between 3 and 4%. You look at this a couple of years ago, they were all down here. So begrudgingly, the Fed is starting to realize that inflation will be higher than their 2% target, and therefore long-term policy rate will be above that 2% target as well. So all of that supports the notion that you need to figure out how to operate in a higher inflation, higher cost of doing business environment. That's part of your success formula into the future. All right, just one quick commentary on the labor market because we're going to go into this much more in depth tomorrow. There's a lot of rhetoric, a lot of coverage right now that the labor market is doing poorly. It is not. It's doing poorly relative to the robust monstrosity that was 2021 and 2022. In general, 142,000 jobs created in a given month, which is what we saw in the month of August, is actually pretty good. You look at historic performance in the labor market, anytime you're somewhere in the 150K jobs created per month is economic growth for the US economy. The unemployment rate is rising. It's currently at 4.2%, but it's rising not because of layoffs. I'll show you more on that tomorrow. It's rising because more people are entering the labor force, coming off the sidelines to cope with higher costs of living. I imagine this number might go up as high as 4.5%, but there's nothing scary out there. Nothing in the labor force that says that we're looking at a recession. And then this is, this point right here, 3.8%. If you're still doing 2% COLA, cost of living adjustment increases, not only are your people not keeping up with inflation, which is above that, but the average hourly earnings in the United States right now are up 3.8%. So when you're thinking about raises for people, adjustments for 2025, This is the number. Somewhere between 3 and 4% is what you should be targeting, rather than the typical pre-pandemic norm of 2%. By the way, I see some of you taking pictures. I will make all of these slides available. By all means, continue to take pictures if you want, but you will get a copy of the deck afterwards. So, I promised you at the beginning, actionable, practical advice. I hope I've been delivering on that promise throughout, but I wanted to really kind of wrap things up with some very, very specific things that I want you to take away from the presentation today. Number one, from a strategic perspective, these are the top considerations I want you to have as you think about planning for 2025. Cash will remain king. Financing costs, even though we are lowering interest rates, will remain elevated and oftentimes prohibitive in terms of borrowing to fund growth. Your customer retention and acquisition rates are potentially going to be pressured by lower demand depending on your market exposure. As I showed you, the non-res sector is decelerating. So if you can shift to offset some of that weakness to the residential sector, that might offset some of that downside pressure. And then that part in red is so key. There were several years where we had this boom in construction that the market was just giving you growth. That period has come to an end. If you want growth, it is achievable by all means, but you're going to have to go out there and take it. You have to grow by market share gains as you look out towards 2025. It is not going to be presented to you on a silver platter. Okay? So the actions that I want you to implement are threefold. Number one, continue to look at your business judiciously. When I talk about that boom period in 21, 22, and 23, many of this fell to the wayside. But you always need to be looking at unnecessary steps in your process, remove all of those steps, and increase efficiency and throughput in your company. These are just good business practices that add company value. Protect your margins. I hope I stressed that point enough. You got to reduce waste and energy use whenever possible. And this is a really interesting opportunity for arbitrage right now. Renegotiate contracts with your suppliers, especially given that there's a lot of pessimism out there right now. Use other people's pessimism to your advantage. You know that there's going to be some rise coming. They don't. So go and try to get better pricing. This is talking about your electricity supplier. This is talking about any vendor that you're doing business with. Go out there and shop around. In particular, if you're having logistics and transportation contracts that are locked in long-term, right now is a great opportunity to go to the spot market and get much better pricing on trucking costs, if that's something that you have in your business. And then lastly, and we'll talk about this more tomorrow, the job market is not as vibrant as it was today, but there are several key positions within your organizations that you cannot afford to lose people in. And so your focus has to be on employee retention, especially to those roles that you cannot do without, because you know they're going to be almost impossible to fill. And I'm thinking about like field service technicians, I'm thinking about your accounting team, I'm thinking about people that we just don't have enough workers in those positions that are available. So, with that, I want to say thank you very much. Here's all of my contact info. The QR code is just my LinkedIn page. I'm constantly putting out opinion and commentary, giving you my perspective on what I think you should be doing. Please connect with me on LinkedIn. And then if you have any questions, now would be a great time. So thank you very much, and I'll take some questions. Thank you. We have a gentleman here up front.
Taking into account current events, what do you think a 90-day longshoreman strike is going to do to your PMI?
So, I mean, the PMI is really quite an interesting, right? It's people's future opinions about what they're going to be buying in the future. Right now, the concerns around the potential East Coast strikes are more on product availability and cost increases, basically, right? And so those tend to be pretty negative when it comes to opinion, if you think there's going to be shortages or you're going to be having a harder time getting it. But I think that it's going to actually require us to see how that develops. Not the fears of it, but if it actually comes to bear. So what I mean here is, if you look at the import of stuff that is actually coming in through the East Coast, the vast majority of exposure is not necessary goods. What I mean is, like, it's fruit, it's nuts, it's things that we could do without. The basic staples of stuff that we're importing are not expected to be affected. Things like milk, eggs, meat, grains, things of that nature. So I would say, yes, as a concept, I would expect it to have a negative outlook on the PMI, and it's foretelling of what's to come down for the industrial economy. But I would like to see how that actually plays out. And with all of these strikes, we've seen it. Sometimes they go forward, other times they don't. So I'm driven by the data. Let's see how that develops.
We have time for one more quick, and then Alex will be at the reception tonight.
Yes, I'll be around for the next 2 days. So if you don't get a chance to ask me something right now, please find me outside.
I'm having a hard time getting around that number, 20 to 30% increase in product cost or cost of goods?
In terms of the overall inflation that we've experienced from 2020 through 2024, prices on average are up between 20 and 30%, and there are categories that are much higher than that.
And according to you, that's sort of the benchmark now, as opposed to those decreasing to a level, say, of 8 to 10 or something like that?
So there's two ideas here. It's the pace of price increases and then what the prices are themselves. My comment was the prices that we're paying today are not going to go back to the prices that we paid pre-pandemic.
Right.
The pace of growth of that price is also decelerating. So if you look on average, inflation has been somewhere between 6 and 8% per year, each of those 4 years. That has now dropped down to 2 to 3% per year. So it'll be easier to cope. We will not see such huge moves in the pricing environment, but we also have to be very realistic and not continue to say, well, the prices we paid 3 or 4 years ago, because at this point, frankly speaking, it's not relevant to the prices that we're going to have to pay from now on out. Does that make sense?
Yeah, yeah.
Okay.
So where's the stock market going from here?
I mean, generally speaking, and please don't take this as investment advice. I'm not a registered financial professional. But generally speaking, when you have interest rates on guaranteed debt going down, equities tend to benefit from that. So I'm cautiously optimistic to the performance of equities between now and, call it, 18 months from now. But I'm at the same time very wary of the geopolitical environment, right? I mean, the thing in the Middle East could blow up at any day. I mean, there's a mild ground invasion going on right now. Obviously, the Russians, you never know what they're going to do. Things going on in the Indo-Pacific with China and Taiwan also are a big concern to me. So I think longer term, I remain bullish on the upside in the stock market, but with a caveat of at any given point, geopolitics can derail that. Okay. Hopefully that's helpful. All right, guys, thank you so much. Enjoy your break.
Thank you very much, Alex. Thank you so much.
Thank you.
Thank you.
Thanks for listening to the Talking Air Filtration Podcast, a production of the National Air Filtration Association. Clean air matters.